Are you building your forever portfolio? This portfolio is designed to generate wealth consistently so you can live comfortably for the rest of your life without running out of money. It takes the stress and the guesswork out of investing, simplifying and streamlining the process. And in today's video, we're going to be going through 6 essential rules for building this portfolio. So definitely pay attention. Now, if you haven't subscribed to the channel, definitely subscribe. The channel is growing, covering finance, financial education, and literacy. So let's get into it. Now, when we start thinking about portfolios, it is a big retirement account, and you have to differentiate exactly how you're going to do it. And the first one in here is picking your investment account. Now, for a majority of people, this is going to be the 401k. This is very traditionally the largest account that we have for retirement. But there are also other options like Roth IRAs. You could do traditional IRAs. You could do Roth 401ks. In my opinion, when you start looking at the options of 401ks and IRAs, I always choose the Roth variation. It lets your investment grow tax-free, which can be super important. It means when you get to the point of retirement, you're not going to have to pay taxes on not only the contributions that you made, but you will not have to pay taxes on the growth that you've gotten in that account. Now, if you're like me, it seems like we're going to be paying a lot more taxes in the future. I would rather know exactly what the bill is going to be today versus just kicking that can down the road. Now, plus investors who expect to be in a higher tax bracket down the road, when you start looking at 20, 30, 40 years of solid growth in a portfolio, it could make a really big difference on how much you're paying when you have to start taking the RMDs. Now, those are required minimum distributions. Once you start getting to a certain age, the government requires you to take money out of that account, even if you don't need it. Now, this creates a tax burden. If you have a lot of money, let's say $3, $5, $7 million in there, you are going to pay an exorbitant amount of tax because it grew to that portfolio. Now, a true forever portfolio is all in Roth funds because, like I said, the taxes are already paid. It also gives you the flexibility to do withdrawals when they are needed, not required to take the money if it is not needed at all. And you can also use this money early with contributions, 59 and a half. So you don't even have to wait till that 73 of RMDs. And you can start taking money out, that 59 and a half, out of these Roth accounts because the balance or the taxes have already been paid. Now, one thing to remember is if you're going the IRA route, they are relatively low when it comes to the contribution limits. You have to make sure 2025 maximum contributions are $7,000. If you're over the age of 50, you can go to $8,000. And then it does have a couple different catch-up contributions, so make sure you're aware. If you're a high earner, you can also have income limits with the IRA variation, meaning that you cannot put money in there unless you do a backdoor Roth. Not going to get into that right now. Now, the second one, develop the right mindset. At this time, looking at the stock market, seeing a couple days, a couple weeks of being down, it is not about chasing quick profit. It is not about timing the market. It is creating a well-diversified strategy that can really sustain you through the turbulent market, the ups, the downs, and everything. Really going on 2 core principles, which you have to remember. Investing is for the long term. I've gotten contacted by a lot of different people that wanted to sell right now. They feel like the sky is falling. Guys, we are seeing right now a market correction, 10% off of the all-time high. So even if we're seeing a market correction, this gives you a massive buying opportunity. If you're selling, that is where you take the losses. You're not going to see the rebound. You're not going to see the comeback. You're not going to see when it comes up in the next couple months. When you sell, you are locking in that 10% loss if you're invested in the S&P 500, and you have to resist the impulse to sell. This is the time when the market is red. There are reasons when you look at Warren Buffett, and he says when people are fearful, be greedy, keep investing when the market is down. We are investing for the long term. When again, thinking of the strategy of the legendary investor, it goes in and he says, emphasizing buying companies that you're comfortable with, investing things you're comfortable with, and looking at a decade or longer. When we start thinking about investments, we think of 5 years or greater. Even Warren Buffett says 10 years or greater when it comes to investing for the long term. It is about the longevity of a portfolio, not the short 1-3 year period, or even the last 6 months that we're looking at. When you start looking at the average return of the S&P 500 over its entire duration, we're about north of 10%. Even looking at the last 10 years, because of tech really driving it, we're at about 12%. Now, of course, like we said, resist the urge to sell. This is the time. And this, if you think about kind of bigger picture, why 401k work and why 401k plans are so effective. You buy every 2 weeks when you get paid, every month, every week, whatever it is. You buy when the market is up, you buy when the market is down. You are looking at the average over an extended amount of time. And this is the reason why, when it comes to portfolios, 401k plans and 401k portfolios are the largest investment account for a majority of people that they will ever see in their life. Now, number three, looking at low cost index funds. These are my ETFs. These are my babies. These are my absolute favorite things. Looking at something like the S&P 500, very broad diversification when it comes to one single ETF in its entirety. By investing in these index funds, not only are you spreading your risk across, let's say, 500 companies in that S&P 500, you're also buying across all of the different sectors, reducing the risk overall in the portfolio. And even if an individual company goes bankrupt, if it plunges, you have 499 plus companies that are still going to hold that portfolio together. This is the reason why, when you look at mutual funds, when you look at exchange traded funds, they have been very widely accepted and very heavily invested in because they have an incredibly low cost. When you start looking at a 0.03%, 0.06%, the cost to own these funds for an extended amount of time is crazy. And of course, because you're not constantly buying and selling, moving out of these, you can defer the capital gains until you actually get to sell them, making a much lower tax bill. Now, number four, explore dividend stocks to produce income. This is why, when I think of the portfolio, 35% of my portfolio is in the HD. And if you do a quick Google search right now, the S&P might be down, the QQQ might be down, the NASDAQ might be down. My HD as of today was still positive on the year. And when we start looking at dividend stocks that produce income, they are producing income on a quarterly basis. We get paid. That is compounding. It goes right back into the portfolio. We are buying more of that SCHD time and time again. When you start looking at quarters, then you kind of zone it out to years. Then you're looking at decades. The compounding of these investment products are crazy. Now, of course, when it comes to retirement, you can flip the switch and put more money into these dividend paying stocks, allowing you to capitalize on dividend or on capital gains, but also having a very constant cash flow that can replace the portion of Social Security. Now, you have to be careful with high dividend stocks. Sometimes they have a very, very high risk. So know exactly what you're investing into. When you look at some of the dividend aristocrats, the dividend 100, there's a lot of different ETFs. There's a lot of different companies, a lot of different profiles, a lot of different exchange traded funds that focus entirely on dividend generation without having an incredible amount of risk. When we start looking at individual stocks, Johnson & Johnson, Procter & Gamble, Coca-Cola, they have provided reliable dividend income for 25 plus years, which is pretty incredible. Now, number five, adjusting your portfolio over time. Forever portfolios are kind of a set it and forget it, picking the right funds. And if you do this properly, you can do regular contributions. You can watch it grow until the balance that you want to get it to. You might have to redefine or refine some of the portfolio eventually to ensure its longevity. If you're in companies and looking at a longer time horizon, again, thinking of 20, 30, 40 years down the road, might be a little bit of an adjustment. Now, historically, stocks have had higher returns than we've seen with bonds. A lot of people getting closer to retirement do like investing in bonds, but I really heed you to do your research, because there's been a lot that has come out of a lot of major investment companies that have come out of a lot of scholarly articles that have said that if you kept your money invested in the stock market versus moving it to bonds, rather moving it to something that is very low to no risk, you would have never run out of money keeping it invested versus moving it, even moving a portion of the portfolio. So keep that in mind. Now, as your timeline really shortens, as you get closer to retirement, again, you might have to reconsider. There might be things that you need, like more cash flow to supplement the Social Security or income you're getting, if there is income. Now, of course, a lot of people talk about target date funds, but do your research. We looked and did all of the research on the Vanguard target date funds that were issued or that were offered through my 401k provider. They severely outperformed everything else we could put the money in. So it was a mix of our large cap, our mid cap, our small cap, a little bit of international. Outside of the target date funds made a big difference. And my return is about 3 to 5% higher every year because I'm not investing in those target date funds. And of course, you could also use robo-advisors. You could use an actual financial advisor. You could use robo-advisors. There's a lot of different options. If you don't want to do it with a hands-off approach, that is going to adjust automatically. And the final one for you guys, speaking with a financial advisor. This is really if you want to set this portfolio for the rest of your life, you might want to talk to a professional. They can manage your investments, but you have to be careful because a lot of times it does come with a fee. We're talking 1% of the portfolio, which might not seem like a lot. When you start looking at 20, 30, 40 years of portfolio, you could allocate roughly 20 to 30% of the entire growth of that to that financial advisor. And they really do keep you on track. If you have a really strong and good financial advisor, some of them do a flat fee for 1 hour sessions, meaning you can sit there. They're not going to charge you in your portfolio. They want to manage the money, or you have a flat fee. You can get it together. You can ask any questions and make sure that you're in there, even if it costs $200, $300, $500 for the time of getting it and making sure a financial advisor kind of puts their stamp of approval on your investment portfolio, which is exactly what I do. So, all right, guys, so that is going to do it for today's video. 6 essential rules for building that forever portfolio. Let me know in the comments what you guys think. And as always, thank you guys for watching.